Here is something most people only think about after it is too late. When the economy starts to collapse, when jobs start disappearing, when stock portfolios start bleeding, when the headlines turn ugly, the average person has no plan. They watch everything they worked for shrink in real time, and they have no idea where to put what is left. But here is what the data shows. Every single economic collapse in modern history, every recession, every crash, every financial crisis, has had a set of assets that did not just survive. They held their value. Some of them actually went up, and the people who owned them walked out the other side in a fundamentally different position than everyone else. Today on Money Simplified, we are going to walk through exactly what those 5 assets are, with real numbers, real historical data, and a clear explanation of why each one works when everything else is falling apart. This is not a doom video. This is a preparation video. Let's get into it. Before we get into the 5 assets, let's establish one thing clearly. A recession is defined as 2 consecutive quarters of negative economic growth. In the United States, there have been 10 recessions since 1956. During those 10 recessions, the stock market has dropped an average of 28% from peak to trough. That is the baseline. That is what the average unprotected portfolio goes through every time the economy turns. The 5 assets we are covering today are the ones that have historically done something very different during those same periods. Asset number 1, gold. Let's start with the numbers. Gold has risen during 5 of the last 6 major U.S. recessions since 1971. The one exception was the 1990 to 1991 recession, which happened during an unusual period of low inflation, post-Cold War stability, and active central bank gold selling, conditions that are essentially the opposite of what we are seeing today. In the other 5 recessions, gold's performance was not just positive, it was often dramatic. During the 1973 to 1975 recession, gold gained approximately 73%, while the S&P 500 fell more than 40%. During the 2008 Great Recession, the S&P 500 fell approximately 57% from peak to trough. Gold rose approximately 25% over that same official recession window, and then continued climbing all the way to $1,907 per ounce by 2011, a 169% gain from the crisis low. During COVID-19, gold dipped briefly in the March 2020 panic alongside everything else, then surged to an all-time high above $2,070 by August. According to Bureau of Labor Statistics data and industry research, gold has averaged over 20% gains during official recession periods across modern history. Why does gold do this? 3 reasons that are consistent across every recession cycle. First, gold is not tied to any single economy or currency. When confidence in financial systems breaks down, gold's fundamental appeal, scarcity, no counterparty risk, thousands of years as a store of value, becomes more valuable, not less. Second, the Federal Reserve's standard response to recessions is to cut interest rates aggressively. Lower rates reduce the opportunity cost of holding gold, which pays no interest or dividend. When rates fall, gold becomes relatively more attractive. Third, recessions produce fear. Gold has a centuries-long track record of attracting capital when fear dominates. That is not an accident. It is a structural characteristic of the asset. The caveat worth knowing: gold can dip sharply in the initial panic phase of a crisis as investors sell everything for liquidity. This happened in late 2008 and briefly in March 2020. Investors who understood this dynamic bought into those dips and were well rewarded. Gold is not perfect in the first days of a crash, but across the full recession cycle, the historical record is remarkably consistent. Asset number 2, U.S. Treasury Bonds. When the economy deteriorates and investors get scared, one of the most consistent behaviors in financial markets is what's called a flight to safety. Money moves out of risk assets, stocks, corporate bonds, real estate, and into the perceived safety of U.S. government debt. This drives Treasury prices up and yields down. The data from the St. Louis Federal Reserve is clear on this. During the 2008 financial crisis, demand for treasuries was so intense that prices actually rose even as the government was dramatically increasing the supply of bonds to fund the Emergency Economic Stabilization Act. Holdings of U.S. marketable treasury securities rose from $4.9 trillion in August 2008 to $7.4 trillion by February 2010 as the flight to safety accelerated. During the COVID-19 crash, short-term treasury bills again surged as investors sought the safest, most liquid assets available. According to a comprehensive study published in PMC covering both the 2008 GFC and the COVID-19 pandemic, U.S. treasuries, particularly short-term bills, were among the most reliable safe haven assets across both crises. In Q1 2025, as recession fears mounted and defensive sectors outperformed, treasuries again saw strong inflows as investors rotated away from equities. The key distinction to understand is short-term versus long-term treasuries. Short-term Treasury bills, those with maturities under 1 year, have been the more consistent safe haven across different crisis types. Long-term Treasury bonds are more sensitive to inflation expectations and can actually fall in price during inflationary crises even as the economy contracts, as happened briefly in March 2020. If your goal is capital preservation during a recession, short-term Treasuries, T-bills, money market funds backed by Treasuries have the most consistent historical track record. The other benefit? You get paid to wait. Current 3-month T-bill yields have been running between 4% and 5% in 2025 and early 2026. That is not extraordinary growth, but it is guaranteed income with essentially zero default risk, a combination that becomes extremely attractive when stock portfolios are down 30%. Asset number 3, defensive stocks. Not all stocks are created equal during a recession. This is one of the most important distinctions that most casual investors never learn until they experience their first major downturn. While the broad market falls an average of 28% during recessions, 3 specific sectors have done something dramatically different across every major downturn in the last 30 years. Consumer staples, healthcare, utilities. Here is the data from S&P Global's comprehensive analysis of the 4 worst market downturns since 1994, periods when the S&P Global BMI fell 20% or more. During those 4 drawdowns, the broad market suffered an average 40% loss. Consumer staple stocks gained an average of 26% during those same periods. Healthcare gained an average of 16%. Utilities gained an average of 15%. All 3 sectors stayed in positive territory during every single one of those 4 worst drawdowns, not just in one crisis, in all 4. Why? The logic is simple once you understand it. Consumer staples are the products people buy regardless of economic conditions: food, household cleaners, toothpaste, personal care. Demand doesn't disappear when a recession hits. If anything, demand for certain staples like alcohol and tobacco has historically increased during downturns as people deal with stress. In Q1 2025, when the S&P 500 fell roughly 4.6%, consumer staples gained 4.6%, healthcare gained 6.1%, and utilities gained 4.1%, all outperforming the benchmark significantly. In 2022, when the S&P 500 was down 17% through the first 8 months, consumer staples were down only 3.98%. Healthcare companies continue receiving payments for services regardless of GDP growth. Utilities, electricity, gas, water, are consumed no matter what the economy is doing. These are not exciting sectors. They do not double in a bull market the way technology stocks can. What they do is something more valuable in a downturn. They stay standing while everything around them falls. The key names in each sector read like a list of the most reliably profitable companies in the world: Procter & Gamble, Costco, Johnson & Johnson, Eli Lilly, NextEra Energy, Consolidated Edison. These are companies that have paid and increased their dividends through multiple recessions. For investors who want recession protection but are not ready to move entirely out of equities, rotating a portion of a portfolio toward healthcare, consumer staples, and utilities ETFs, XLV, XLP, XLU, is one of the most historically reliable defensive strategies available. Asset number 4, multifamily real estate. This is the one most people overlook, and it is arguably the most powerful recession-resistant asset on this list when you understand the data behind it. Here is the core reality. People always need somewhere to live. Full stop. No matter what happens to the economy, no matter how severe the recession, shelter remains a basic human need. And that structural reality shows up in the data in a way that is almost impossible to argue with. According to Federal Reserve data covering 70 years and 10 U.S. recessions from 1956 to 2022, the national apartment vacancy rate has never exceeded 10% in any recession period. It has remained between roughly 5% and 10%, meaning occupancy has stayed above 90% through all 10 recessions, including the Great Recession of 2008 and the COVID-19 crash of 2020. Vacancy rates during recessions have never increased more than 1 percentage point in any single downturn. Compare that to the stock market, which has declined an average of 28% during every recession. During COVID-19, the most severe economic shock in a generation, apartment rent collection rates averaged 94.7%, just 1.5 percentage points below the corresponding pre-pandemic months. Even in a global pandemic that shut down the economy, 95% of renters paid their rent, and rents have grown nationally across 9 of the last 10 recessions. Only once, the Great Recession, did rents decline. And even then, they only declined 0.73%, compared to the S&P 500's drop of 46.113% during the same period. Over the last 40 years, multifamily has outperformed every other real estate asset class with better overall returns, better risk-adjusted returns, and lower volatility than commercial, retail, or office real estate. As of early 2026, rents remain approximately 25% higher than pre-pandemic 2019 levels, even as growth has moderated. Investment volume in multifamily accelerated to a 3-year high in late 2025 as institutional investors anticipated supply headwinds easing and demand remaining structurally strong. The caveat: multifamily real estate requires capital, management, and expertise that most individual investors don't have direct access to. For most people, the practical exposure comes through REITs, real estate investment trusts, specifically residential and apartment-focused REITs that hold large multifamily portfolios and pay dividends. These provide access to the underlying recession-resilient characteristics of multifamily without the direct ownership complexity. Asset number 5, cash and cash equivalents. This one might surprise you. Cash is often dismissed as losing to inflation. And over the long term in normal economic conditions, that criticism is valid. But in a recession, cash does something nothing else can. It gives you options. When the economy contracts and asset prices fall, the investor with cash is the investor with power. Cash allows you to stay in control of your decisions rather than being forced to sell at the worst possible moment, which is exactly what happens to investors who are fully invested in risk assets during a crash and suddenly need liquidity. Cash means you are never a forced seller, and it means that when prices fall to genuinely attractive levels, which they always do during recessions, you have the capital to act. The specific forms of cash that provide the most value during a recession are those that earn a return while maintaining liquidity. High-yield savings accounts, money market funds backed by treasuries, and short-term treasury bills have been yielding between 4% and 5% in the current environment. That is real income with effectively zero risk. In the 2008 recession, investors with cash were able to buy the S&P 500 at prices that represented a 57% discount from the peak. Those who took that opportunity with the cash they had preserved during the downturn participated fully in one of the greatest bull markets in history. Investors who had no cash, who were fully invested and forced to sell, locked in their losses and missed the recovery. The psychological challenge with cash is real. Holding cash when markets are rising feels painful. You watch gains accumulate elsewhere and wonder why you're sitting on the sideline. But the purpose of a recession-resistant cash allocation is not to maximize returns in good times. It is to preserve your ability to survive the bad times and to capitalize on the opportunities that only downturns create. Most financial planners suggest a recession-ready cash reserve of 3 to 6 months of living expenses at minimum, held in high-yield accounts or money market funds. Some more conservative approaches recommend an additional 10% to 20% of an investment portfolio in cash or cash equivalents during periods of elevated recession risk, a buffer that transforms a potential crisis into an opportunity. Let me bring all 5 of these assets together into a framework you can actually use. Think of these 5 assets in 2 categories. The first is protection assets, things that hold or gain value during the recession itself. That is gold and treasuries. Both have long track records of performing well when equities are falling and fear is high. The second category is resilience assets, things that don't collapse during a recession even if they don't necessarily surge. That is defensive stocks, multifamily real estate, and cash. These assets maintain their fundamental value through the downturn and position you to participate in the recovery. The most important insight from all of this data is not which specific asset performs best during any particular recession. It is that diversification across these categories has historically produced the best outcomes. Investors who owned a mix of gold, short-term treasuries, consumer staple stocks, multifamily exposure, and a cash reserve consistently experienced smaller drawdowns, maintained psychological stability during crashes, and were better positioned to take advantage of the recovery than investors concentrated in growth assets alone. No recession is identical. The 2008 crash was a financial system collapse. COVID-19 was an exogenous shock followed by the most aggressive fiscal and monetary stimulus in U.S. history. The 1973 recession was a commodity and inflation shock. Each had different dynamics that affected different assets differently. What is consistent across all of them is that these 5 asset categories maintained their fundamental value while traditional equity portfolios were falling apart. The question is not whether the next recession is coming. Recessions are a predictable, recurring feature of economic cycles. J.P. Morgan's current recession probability estimate for the next 12 months sits at 40%. Goldman Sachs has moved its estimate from 35% to 45%. Whether those estimates are right or wrong, the time to prepare is not when the recession is already underway. It is right now, when you still have the opportunity to make calm, rational decisions about where your wealth is positioned. One final reminder. Everything you've heard on Money Simplified today is educational. I am not a licensed financial advisor. Your specific situation, your income, your timeline, your risk tolerance, your existing portfolio is unique to you. Before making any changes to how your money is allocated, please speak with a qualified financial professional. What I have shared today is a framework, not a formula. If this video helped you understand what actually protects wealth during an economic downturn, without the hype, without the doom, hit that like button. It helps Money Simplified reach more people who need this information before they need it. Next, we are breaking down exactly how to build a recession-resistant portfolio from scratch, what allocations, what accounts, and what to do first. Subscribe so you don't miss it. See you in the next one.